Pro-D funds came about as a result of feedback from Australian advisors who were saying they were really happy putting the more active approach to asset allocation in place for their clients. And while it worked very well for large clients, for smaller clients it was difficult to spend the hours it requires to actually do the work and then charge fees that still made sense. And so for them, having that all packaged up in one place really made a lot of sense. So the result of that with the three funds, the balanced growth and the high growth, which target different levels of risk and really very good for, or were designed initially for smaller clients to pick one of those funds, and that would be their portfolio. Of course, a lot of them are using it for small clients, which is where they were designed. But what we're finding is some advisors saying these actually make a lot of sense for their larger clients as well, using the Pro-D funds as the core for which satellites can be put around. The satellites can either be specialist equity funds, or in some cases the Pro-D funds is used for the growth part of the portfolio, and the income part of the portfolio is run separately, and that might be in term deposits, government bonds, or whatever seems to be appropriate at the time. Term deposits, as you all know, are what we're favouring right now, and that really makes a lot of sense. The asset allocation of the funds, the core principle is we never want to own expensive assets. So we want to buy expensive assets, and if we buy reasonably priced assets that subsequently become expensive, we're going to be selling out of them. We won't be necessarily selling out on day one, but we will sell out over a period of time. So the end result of that is we set a neutral asset allocation, and that is pretty close to the maximum level of risk we'll take in a fund. So we might go a little bit overweight risky assets, but not very much. Where the big moves in the fund are going to be will be when we see markets getting expensive, we'll start selling out, and if needs be, if markets are expensive enough, we're really happy with the idea that we'll own zero risky assets or growth assets in these portfolios. And that makes these funds dramatically different to anything else in the market. Everywhere else in the market, even those who are taking a more active approach to allocation, will never get down to zero weight equities, no matter how expensive markets are. And we think that's the fundamentally important thing. These portfolios should be managed in exactly the same ways as direct clients are being managed, where you've got larger balances, and in the event you think everything is expensive, you won't own any equities. We don't see any need to own them all the time. Having said that, right now equities are much more attractive, and we're really quite happy to own a pretty full weighting in risky assets. Right now we're fully invested in growth assets, and that's because we see reasonable value in the equity markets right now. Within growth assets though, we're overweight Australian equities where we still can see good value. Within international equities though, we're underweight, and we're underweight listed property trusts. Then the next step down within Australian equities, we like the smaller companies, and so we're starting to push the weighting away from the very large cap, the top 20 odd stocks, into the medium caps and smaller caps. I'm really comfortable with that position. Within international equities, we think developed markets don't look nearly as attractive as emerging markets. Up until now, most of our exposure has been in the developed markets, and that's starting to move away now, and we're going to be starting to push more money towards emerging markets. And all of this is pretty much what advisors are doing in their own portfolios right now. Getting away from the growth assets into the secure assets, the focus has been not on government bonds, which we haven't liked and still don't like. We've been much more interested in bank securities. Up until now, most of that has been into shorter term deposits. We're now moving that out of that into some bank bonds, which will give you very similar rates to term deposits, but you get liquidity with that, and it's much more suitable for a managed fund where you need day-to-day liquidity. So that one's really working well for us.